Hello again, everyone. In this technical analysis of the stock market video, I call it 211 degrees. What is 211 degrees? It is 1 degree shy of the boiling point. And I think the stock market is very, very close to the boiling point. There is very little fear in the market right now. Very complacent type of feeling that you get. The market yesterday, Friday, was the lowest volume day since mid-February. It's kind of a dull, slow summer day. But I think we're very, very close to the boiling point, 211 degrees. All right, we're going to start off here and take a look at the Dow Industrials. You can see the Dow was up 34.30 yesterday. And it's interesting that on Tuesday we had this reversal candle in here. See this reversal pattern? But we didn't get any follow through down. So I'm really watching right now to see, do we get a close Monday or Tuesday below that low? I think if we get a close below that low, that could be the start of something to the downside. But you know, the S&P 500 is bumping up against the all-time high. It's bumping up against its February high. I have a feeling the S&P is going to punch above that high. And if it does, then the S&P, there's no way that you can say that the S&P is still in a that this is a bear rally, because it would have taken out that high. Now we could end up getting a whole mix in terms of mixed picture, just like at the top of 2000, where you know the Dow topped out in January and the S&P and the Nasdaq topped out in March. We'll see. The other interesting thing, let me just show the weekly chart here on the Dow. It was up 497.5 points for this last week. So it's continuing a pretty strong little push here over the last 2 weeks. And it is the highest close since the week of February 23rd. So we're rapidly approaching that high also. So it's also been 5 months. And it's kind of interesting. I did talk about this in a post on my website. Let me just pull that up. Okay, so a recent post reminiscent of stock market crashes. And so I talk about how this, what I call the COVID crash, compares to a couple of other very major crashes that we've had, 1987 and 1929. And I talk about how it looks in terms of 5 months out, which seemed to be kind of an interesting turning point in both cases. So is this going to be 1988 or is this going to be 1920, 1930? You know, we'll see. And I talk about what happened in both those cases. Of course, there are a lot of folks know what happened in 1930 and on for a couple of years, but we'll take a look at the details in this post. So check it out, joehenches.net. And while you're there, check out the membership. All right, so we're coming up on this point. In about a week, we'll be 5 months, and it's going to be really interesting to see, do we come down, start to break down, or do we keep pushing, come up here, take out the all-time high, and gradually keep pushing? So if I take a look at the Elliott Wave picture in here, this is the picture that we've got for the bear mode, the bear rally off of the March low. Okay, and so far this is still valid. You know, a wave 2 pullback like this is still very much valid until you come back. A wave 2 just can't go beyond the beginning of wave 1, right? Okay, that's just the way it works. But if we continue pushing, we take out this high, I do have an alternate count, and clearly you'd have to default to the fact that, you know, this wave, this March low was an intermediate wave 4, and we're in intermediate wave 5 to the upside. Okay, so we've already been looking at that, been analyzing that, but we're not quite there yet on the Dow Industrials. We're almost there on the S&P 500, so we'll see what happens. Let's take a look at a couple of our indicators. Now, the VIX is really interesting in here because it didn't move very much, down 0.08 on Friday, and you can see it's just been riding for practically last month, just riding below that blue line, which is the 10-day exponential moving average. Here on Tuesday, when we had that reversal candle here on the Dow, the VIX really put in a potential reversal, you know, the opposite of what you saw in the price action, but we didn't get any follow through. It didn't rise up, it didn't break this trend line, but it just smells like, it just feels like it's, you know, like there's that complacency and just everybody's just kind of very calm right now about this. Now it's not down here. I mean, down here, like last year in the fall, I mean, this was just pure no fear at all. I'd have to say there's a little fear in the market right now. I mean, we're still above 20 in terms of the volatility and the volatility expectations that are built into the S&P 500 options. Okay, but it's pretty calm. It's just that calm type feeling. So if we get any kind of break in this market and we break this trend line, it's going to be very interesting to see what kind of eruption we get. Now, the other thing I'm looking at, we look at this every day, is the high yield bond fund, HYG. Now, all of a sudden, this is starting to say risk off. Okay, so here we go, the end of July 31st right here, and it just started flatlining. And the market kept pushing higher. The S&P, everything just, kept pushing higher and higher and higher, and HYG refused to go higher. And now it's rolled over, and basically it's starting to say risk off. So now for the first time in a while, we are starting to get a contrary move to the market, to the stock market. Okay, and I've been waiting to see that because I really, like to see HYG giving some, an indication, giving some clues, and it just wasn't doing that, but it's doing it now. All right, and then the last thing I'm going to mention, we'll talk about put to call ratios. And I always talk about the put to call ratio, and I show my spreadsheet. I have a color. It's like a dashboard in terms of color coding the extremes, both for bearish and bullish type of thing. But I came across a tweet here. Let me pull it up. Came across this tweet this week from Sentiment Trader, and it was on Tuesday, the 11th. You could see this, and it was first thing in the morning, so it had Monday's trading or whatever. And he was talking about the put to call ratio, and he uses a 50-day moving average for this example, and I use a 10-day moving average on mine. And he said the 50-day moving average is at the lowest level in the past 20 years. So what does that mean? He says, do we have a pullback correction coming, something to be concerned? I mean, we look at the chart clearly, here's where it is. It's much lower than anything that we've seen in the last 20 years. And I thought that is really, really interesting. So it just reinforces the exact type of extreme sentiment that we're seeing right now. We're seeing more extreme sentiment here with this put to call ratio in the last, since June, since right in here. So then we're seeing more than what we even saw back here in January, February. It's just amazing. So everybody's gotten all on board the bull camp. We'll see what happens. All right, that's it for this video. If you felt like the video was helpful, give it the thumbs up. And remember, we're 211 degrees, so be careful. Everyone have a great weekend. Be safe, and we'll talk to you on the next video.